I set a target, the target was hit, and I still gave up the profit. This is the story of my DLF trade, where the analysis was right, the entry was right, and one execution mistake wiped the gains. If you trade option spreads on Zerodha Kite, watch this. It will save you from making the same mistake. July 3rd, 3 p.m., I ran my daily sector scan. Realty was the top ranked sector, up 1.3%. DLF was the strongest stock in that sector. 4 consecutive bullish closes, volume above average, no resistance above in the 60-day range. This checked every box in my entry framework. Before placing the trade, I checked IVP, IV percentile on Opstra. DLF's IVP was 71.03. Above 70 means options are slightly expensive. Not the time for a naked buy, Vega would eat your premium. The right structure, a bull call spread. Long the 670 call, short the 700 call, net debit paid 11 rupees 85. This is my maximum possible loss on the trade. Here are the Greeks I checked before entering. The 670 call had a delta of 0.45, right in the sweet spot. Theta was minus 2.5 per day, manageable with 27 days to expiry. Vega exposure on the spread was significantly reduced compared to a naked long. The net delta of the spread was 0.20, meaning for every 10 rupee move in DLF stock, the spread moved 2 rupees. All 4 checks passed. I tagged this high conviction. Here is what the position looked like immediately after entry. Long 950 lots of DLF July 670 call at 22 rupees 70. Short 950 lots of DLF July 700 call at 10 rupees 85. Net debit 11,258 rupees. Max profit if DLF closes above 700 at expiry 17,000 rupees. Risk reward 1.5 to 1. 3 days later, July 6th, 11 a.m., DLF gapped up in the morning. By 11 o'clock, the 670 call had hit 27 rupees. Target achieved. My GTT was set to trigger at 27. I was away from the screen. I expected it to close the trade automatically. It did not. Here is exactly what happened. The GTT tried to sell my 670 call, the long leg of the spread. But the moment you sell only the long call in a spread, the short 700 call becomes a naked short position. A naked short option requires 5 to 6 times more margin than a hedged spread. My account had 36,000 rupees available. The naked 700 call required over 1,13,000 rupees. Kite rejected the order. The GTT fired, but the trade did not close. By the time I saw the rejection and understood what happened, DLF had already started reversing. The 670 call went from 27 rupees back down to under 20. Not because my view on DLF was wrong, DLF underlying was still positive on the day. The call price fell simply because the stock pulled back from its morning high and implied volatility compressed. The entire profit was gone, not from a bad trade, from a bad exit mechanism. Here is the rule I learned, the hard way. Never use a single leg GTT on a debit spread. When you GTT exit only the long leg, the short becomes naked. Kite rejects it. Every time. The right way to exit a spread. First, set a price alert, not a GTT, at your target price. When the alert fires, go to Kite manually. Step 1. Buy back the short leg first. This removes the naked position risk. Step 2. Then sell the long leg. This is just exiting a plain long option. Zero margin needed. The sequence matters. Short leg out first. Always. The trade is now fully closed. On July 7th at open, I exited the 670 call at 18 rupees 65. That brought the long leg loss to 3,847 rupees 50 paise. Combined with the 1,900 rupee gain on the short 700 call, the final net loss on this trade is 1,947 rupees 50 paise. Not what I planned, but the lesson is worth more than the loss. This is what the 3 p.m. trader is about, not a highlight reel. Real trades, start to finish. The DLF trade is done. Analysis was right, entry was right, execution had a flaw, and now it is locked in as a rule. Subscribe if you want to follow the next trade from entry to exit. See you in the next one.